Okay, flexible budgeting. Now, a flexible budget is one that's prepared for a different level of volume. Okay, so it's volume here that we're looking at than the one originally anticipated. And that gives us an apples to apples comparison. So if I planned on, 2,000 units and we actually only sold 1,500 units, then part of the differences in our results is just going to be because the volume was different, not because of problems in our process. So this gives us an apples to apples comparison. It's for performance evaluation purposes at the end of the period. And the way you want to think about it is your actual sales volume times the budgeted assumptions. And when they say budgeted assumptions, they're really talking about price. So master budget variance is the difference between actual revenues and expenses and the master budget. Okay, so this is what we really started out with at first, was you figure you've got your actual quantity here and then budget way over here. So that is master budget variance. But remember that the master budget is just for planning purposes at the very beginning of the period. Okay, and this is apples to oranges. It isn't anything you can help manage from. That's the problem with it. So here's an example of a master performance report. And remember, this is the apples to oranges one. I've got sales volume across the top here, and our actual sales volume was 32,320, and the budget is 30,000. So I've got a variance right there due to the difference in volume. Of course, all these numbers could be off, all right, at least the variable ones. Fixed expenses, not so much. These won't be affected by volume, but the sales and variable expenses will be. Okay, so what we need to do is take this apart a little bit more so we can see what's happening inside the organization. Okay, so this is just actual budget plus master budget. Okay, that's master budget variance. You need to know the names of these things too, okay, just so you know. Now, differences, just to show you, this is what the next chapter is about, but variance between actual and budget can be for a lot of reasons. For labor, it could be that the company paid more for employees because the labor market was really tight, okay, the way it used to be before the virus. Or it could be because the employees spent more time on a product than what was budgeted. And you could have had employees that were either poorly trained or, totally not ready to do the job. Okay? So there are a lot of different reasons, and it tells you a lot about your operation. For material variances, it could be because materials are more expensive, okay? Or it could be because more materials were used in production. Maybe you had a machine problem, and it kept breaking down and ruining some material, and you'd have to start over again. So this is an example, a structural example of a flexible budget performance report. Here's our same master budget before. We had 30,000 that we planned on, and the actual was 32,370. But we're going to add a column in the center that's going to be the flexible budget. And what the flexible budget does is it takes the same volume, same sales volume, times the standard assumptions. So we planned on $20 a case. $20 a case times 3270 would have given us this number, 347. Okay, these are all the numbers that we planned on for variable expenses. We'll take these times the flexible number of cases sold, the actual number. Okay, so we'll do that to figure out what we're calling a flexible budget variance, and that is actually due to changes in price because the quantity is the same. All right, and over here we'll calculate volume variances. Here's my flexible budget for 32,370. My master budget is 30,000. So in here I'm actually using the standard prices, right? We calculated these numbers using the standard price. And this would also use the standard price, but the difference between these two will be the quantity, the volume. So this will be actual and this is standard. Okay. So volume variance, that's the difference between the master budget and the flexible budget. So we're over here on this side, master and flexible. So when you think about these sheets, you've got actual, flexible, and master. Okay, that's the order that they're in. So the difference between master and flexible is volume variance, and it only arises because the actual volume differs from the volume originally anticipated. Okay, so that gives us good information there. You know, how much of the variance is just due to a change in the volume. Okay, so we'll use the standard prices and just segregate volume. Here is the volume variance for Tucson tortilla. So we've got our master budget here. Okay, that's pure budget, and here's the flexible budget based on actual numbers of cases sold. And this is the variance due to changes in quantity. Okay, so you can see our variable expenses, they were all unfavorable. Okay, you wouldn't have known that, but the sales revenue was very favorable. We sold a lot more cases than we thought we would sell. Okay, 2,370 more. So that's why we've got this variance. Okay, total volume variance is 2,370. It doesn't look like that much, but look at this. For cost of goods sold, we've got a big variance. Okay, 28,440, that's a lot of money. So we'd have to take a look at this and see what happened. Now the fixed expenses are all the same because these are standard. They're not affected by quantity. All right. Okay. Now flexible budget variance is the difference between the flexible budget in the middle and the actual results. And this highlights variances due to causes other than volume. So I've got flexible, remember this is our order. It helps me to keep this in mind in my head because then I'm just sort of filling in mental blanks. Okay, there are a lot of blanks up there. So I've got actual, flexible, and master. And here's flexible budget variance is here, the difference between actual and flexible. And then volume variance is the difference between flexible and master because this is going to be actual quantity. Right? This is going to be standard quantity. This actual is going to be actual quantity and actual price. Okay? So let's go back to our schedule. Here is this too small? I hope it's not too small for you to see. It's a little bit better. So here I've got a completed flexible budget performance report. So the flexible budget performance report gives me actual, flexible, and master. Here's my volume variance that we just looked at, and this is the variance that's due to changes in volume. Okay, right here. So we can see that for sales, I'm sorry, not volume, price. We can see that for sales, we actually sold it for more than $20 a case on average. Okay, cost of goods sold though is still unfavorable. So our prices were different here than we planned on. Commissions are also unfavorable. We paid more than $1.50 per case sold. Shipping expense was favorable. Shipping apparently, hit their number and did a little bit better. So shipping was less than $2 per case, and then bad debt expense was also unfavorable. So that's good information right there. If bad debt expense is unfavorable, then, did our credit terms loosen up? Are they giving credit to people that they shouldn't have? So that's something you might want to investigate. Okay, we've also got a slight difference here in salaries. So somebody got more money. And a difference also in advertising. So we decided, and maybe that additional investment in advertising resulted in the increased sales. Okay. All right. This is one of those chapters that the practice is going to make a big difference. Now this also applies to the next chapter also, but the way I'd like you to start thinking about it is this is our basic formula or format. We've got actual, flexible, and budget. Okay, and what I would do is when I think of actual, I think of actual price times actual quantity. Okay, then take that actual quantity and carry it over to the middle. Flexible is the actual quantity, right? Because that is actual, not the standard, actual quantity, but times standard assumptions, times the standard price. And what's budget? Standard price, standard quantity. So you can take that standard price and pull it over a little bit. So let's just look at actual and budget. Actual is actual price, actual quantity. Budget, standard price, standard quantity. That makes sense, right? Those are our two purest. These are actual results, and was our master budget here. Now in the center, I'm going to have flexible. What will the flexible be? Flexible uses the actual quantity, but times standard assumptions. So the spending variance will be the difference between actual and flexible. If you subtract one formula from another, you can see that the actual quantity is the same, a common term in both. So I can take actual quantity times the difference in price. Actual price minus standard price. Okay. For volume variance, you see that the standard price is the common term. The quantity is what's different, because remember, this is volume variance. In this case, I'm going to take my standard price times the difference between actual quantity and standard quantity. Okay. It's just, to me, it's always helpful to have something like this that I can get anchored on. So if I'm looking at a problem and there are numbers all over the place and I'm confused and I don't know what's actual, what's standard, what's this supposed to mean, and then it's, so much per case times so many cases, and, you can get all confused. But if I've got something like this to anchor myself on, I'll be more successful, and I'll get less nervous. Okay? So that's just for me. It might not work for you. You might like it the way the book does it better. All right. Now the underlying causes of variances are really what's important. Okay, so let's say I've got a flexible budget is flexible budget variance is favorable. Okay, and the volume variance is favorable. Okay, that tells us that we sold more and for a higher price. And the master budget variance would be the total of these two. Okay, this is in total. So this is our total flexible budget variance. Here's our volume variance. They're both favorable. So the master budget variance would be the total. Okay. Now here in the next one, we're looking at sales commissions, and we've got two unfavorable commissions. Or unfavorable variances, sorry. So, and what this could mean is we paid higher commissions than planned, and we paid more, okay? But we had a volume increase. We sold more, so that would make sense. So here's where we paid more. The paying more, or like a price variance, resulted in or spending variance, you can think of it, is a 1305 unfavorable variance, okay? Unfavorable variance. And the volume variance also is unfavorable. 3555 is unfavorable just because of volume. Okay, so again, the master budget variance, the difference between actual and budget, would be the total of these two, 4860. Okay, now let's look at the next one. Now we've got shipping expense variance. And we've got one that's favorable and one that's unfavorable. On one hand, we paid lower shipping expenses, lower than planned, but like we planned $2 per carton and it came in at something less than that. So that would be favorable. The volume variance, though, on the other side, is unfavorable. The volume was higher than expected. We shipped more than we thought. Okay, this isn't shipping's fault. It's because they sold a lot, so that makes sense. So we sold a lot, so that's unfavorable, but we did well on the numbers. Maybe they were able to pack the containers more full. Okay, so what's the master budget variance? It's going to be like the sum of these, only say that 4740 would be negative. So 2560 minus the 4740, my master budget variance comes out to be 2180 unfavorable. Okay. Alrighty. We'll do a lot of problems on this, so hopefully it'll be clearer by the end of class. Investigating causes for variance is important, and what we do is management by exception. You want to read the paragraph about that in the text, so you've got some context there. And that means we look at the big things, okay? We look at what makes a difference. We need performance reports to understand how operational decisions affect the company's finances. What result did it have? Okay, because this is the one thing that actually starts to tie the numbers